All right, I think we're gonna get going here. Last session of the day. Everyone still fresh? Still ready to go? Yeah? Give me some more energy. Come on, let's go. Yeah! Woo! All right, we're about to hear a pretty good story, I think. And it's my pleasure to introduce, Shane Williams. Shane has a long, history in the industry. He was CEO of Skeena, VPO of Eldorado Gold, and he led projects for Rio Tinto and Conus Gold, or Conus Iron. So he's definitely had a lot of experience, as an engineer and as an operator. You've probably heard of Madsen Mine, a couple failures, but third time's the charm. So I think this is a big, turnaround opportunity. The NPV after tax at $2,000 per ounce was $500 million. So I think there's a lot of room to grow here. And without further ado, I'd like to introduce or welcome to the stage Shane Williams.
First off, thank you to everybody for showing up. We got the last, but you did get the best for last, so I will say that. So some of our qualifying statements, a little bit on West Red Lake Gold. We are a producer, so we're producing at the moment. We started producing in March of this year. We're ramping up. We've been ramping up for the rest of the year. We had our bulk sample, which we did from our de-risking. We've worked forward on building a rare new gold mine. There's very few companies here today that I was here last year, we were a developer. We've moved a year ahead, we're a producer. 2 years ago, the company didn't even exist. So we've moved really quickly from buying an asset, doing the work, getting a project, and moving into production. So the Madsen mine is located in Red Lake region of Canada, high-grade gold area. Over 16 million ounces of gold has been produced in this area. High-grade, around 16 grams per ton is the average grade. The Madsen mine has had a bit of a history. Pure Gold was the previous operator. They drilled, did a feasibility. They spent $350 million on the project. They obviously ran into some issues. We managed to find an asset, buy it out of bankruptcy, and we bought it for $6.5 million in cash. The mill was running. It was permitted, brand new mill, tailings dam, everything was done, everything was run. So go back 2 years ago when we built that asset. Basically, nobody cared about gold. Nobody thought gold was at $1,900 an ounce. We managed to buy that asset, restructure it, and spend the next 2 years to put it back into production. So we're both a play on gold versus a value play, really buying something for pennies on the dollar, effectively. Again, what went wrong? And I won't get into too much detail here, but really it was basically their lack of geological understanding. At a high level, the purple lines are basically the understanding of the previous operator had, or the blue lines was the previous operator. The purple lines is actually what the ore body does from drilling, and then we've done all the level of drilling, and now we're down to this is what actually the ore body looks like. So when you look at why did they fail? One of it was really the lack of understanding of the ore body. And how did we get to that understanding? That was basically a lot of drilling. We have drilled over 100,000 meters since 2023. Basically, in Red Lake, the key is to drill this very, very tightly spaced. So we've drilled it at 7-meter spacing. So that's a lot of drilling post the project going into production and ramping up. So that's a lot of drilling put into the right areas. At the end of that, we did a bulk sample. We basically took 3 or 4 areas of the project. We took what the resource model should say. We actually mined those areas. We put it through the mill. We processed those areas, and we did the reconciliation results. And as you can see, from 3 or 4 different areas of the mine, we basically ended up with getting 3 or 4 areas of the mine within 5% reconciliation. So that shows that all the work we've done, the resource was working as planned and as focused. We also did a lot of capital projects. We put in a connection drift, we put a tailings dam in, we put a new camp in, we did underground development, we dewatered the mine, and we bought a lot of new equipment. So all that's needed. The previous operator had not done the drilling, had not understood the ore body, and also had not put these capital projects in. Really because they weren't an operator. They didn't understand what's needed for the mine. They never ran a mine. They were a group of geologists, exploration people who'd never done project development, never done operations. So if you don't have these fundamental elements in place, then you won't be successful for the long term. As I said, we're now, since mid-January to mid-June, we've produced over 5,000 ounces of gold. We're up to now 6,000 ounces. We had another pour last week. And as you can see there, as we've ramped up over the last number of months, we've ramped up between March, April, May to June. Getting over in July, we poured over 2,500 ounces of gold. So we're having that ramp up, we're getting the grade up, we're buying new equipment, we're bringing on new equipment, we've more equipment to come. The plan to the end of the year is to average about 4,000 to 5,000 ounces of gold per month. And the steady ramp up is there. The plan for next year in 2026 is about 60 to 65,000 ounces a year. So at a run rate, that's roughly 5,000 ounces. So by the end of the year, we plan to be at that run rate of the project. I'll skip this a little bit. We put in a pre-feasibility study earlier this year. It was about $500 million, these are Canadian, MPV. The grade of the project is very high grade. It's 8.2 grams per ton. With that project, $94 million in cash flow. And that was done at as $2,000 gold. So that'll show you where today's economics are. That was done at a $2,000 gold when we put these economics together. It's 800 ton a day mill. You can see the facilities in place. It's a fully operational mine. It has a shaft on board, all the mill, everything. Everything was bought for $6 million. We also bought tax losses associated with that. So as part of the bankruptcy process, we bought $170 million of tax losses. So we actually don't pay tax for a long, long time in Canada, basically. So as well as the value we bought the tax losses as well. Again, base case of the project, I went through a lot of this detail, but what we're actually finding now is the mine design was done at $1,680 gold. So when you go back to how we did the mine design, the original design, the design was done at $1,680 by consultants. So you can look at where we are today in gold, and when you do the redesign at those and use that as we're in production, it makes a big difference to the mine, the efficiency of the mine, how you develop the mine. This is just an example of the mine. One area, the South Austin area, as you see, it was originally like this was it. We drilled the area, it grew in ounces and tons. Another area, we started here, it grew in ounces and tons. And as we're going in, doing the work, using the new economics, using that process, we're finding an average grade is increasing, the tonnage is increasing by 200%, and the grade is increasing by 300% in ounces. So as we're going in, we're finding all this in the new criteria. You know, a lot of projects are talking about large production in gold, large ounce production, but they're 3 to 4 years out. Look, the gold market is happening today. In the next 2 years to 3 years, the gold market is going to go crazy, I believe. You cannot wait for projects. You're looking for cash flow today. So our concept was to take a small mine, start small, but use that cash flow to grow slowly. There's the tortoise and the hare approach. We're going to be the tortoise. You know, we could get a much bigger project, big ounces, 200,000-300,000 ounces, start big, but it could take us 5 years. This mine today in Ontario with this sort of thing would cost $1 billion and would take 7 years to go into production, easily. Rather than start small and grow that over time. That's the approach we've taken. I don't know if some of you saw Frank. Frank did a presentation. Frank is a big shareholder of the company. Frank was the one who we got together. We put this together, myself and Frank as a group, put this together. The idea was to take a project when the gold was very low, buy it cheap, and then grow that and use that as a platform to grow into a bigger company. That is the concept of the project. Again, why do those bigger stopes make a difference? Basically, it makes it cheaper to mine, and originally now in the current gold market, anything over 2 grams is economic. That'll tell you all with today's gold price. So you can mine a lot more tons, you can mine a lot more grade. This is another area, one of the complexes. Originally, people thought Madsen was a very remnant mine with lots of little small stopes everywhere, and how would you make it profitable? This is what, because of the drilling, this will give you an example of what has been done. This is one complex of the mine, and basically 40% of the ounces for the rest of 25 are just in 5 stopes. So that'll give you the concept of one team is mining in that area for the next 3 months. That's it. In that area, focused on that area, producing gold. Again, high grade. Red Lake is known for its high grade gold. There's mines very close that have lots of high grade. These are fantastic grades. When you see these grades, not just in one area of the mine, spread all over the mine. 3 grams, 3 meters at 50, 2 meters at 11, 8 meters at 43, 12 meters at 61, all over the mine. And the grades are impressive, but more importantly is the widths. If you look at the widths, you know, everybody has high grades, and the market is impressed by high grade. But if the high grade comes with the widths, that's where you can build the volume of material to mine, the high grade material. So again, as an example, 10 meters, 114 grams per ton over 10 meters. You build big stopes, big mining areas. A couple of those, 18 meters over 48 grams, 10 meters over 12 grams, you know, 16 meters over 8 grams. These are what creates the bigger volume, the bigger area, the higher throughput. Again, recent drill results. You know, some fantastic drill results. People like to look at that, 7 meters, 1,600 grams over 0.7 meters, 1 meter over 232. But what's more important to me as a mine builder and a mine developer is the widths. 10 meters, 114, 4 meters at 52. This gives you the ability to build scale, build a project, build a base for the project. So again, back a little bit, we had an original study that we focused on with the MPV 500 million. What we're finding is we're going in, we're getting larger stopes, larger mining complexes, bigger growth. Then what we're adding is on top of that, we're getting new deposits that are very close by. One recently, we had the Rowan deposit. We came out with a PEA this week, and that has 35,000 ounces a year. That material can be brought to the Madsen mill, can grow the project. So that's quite close, it's 80 kilometers away. That's more ounces that can be brought. Because we have the mill, the facilities, the tailings, everything there, we can bring material in there to grow the project. Here's an example of a fork deposit. It's within 200 meters of our existing development. Sorry, I'll just go back. Within 200 meters of our existing development, there's a fork deposit. It has, at 9 grams per ton, 30 to 40,000 ounces, and it's open at depth. It's within 200 meters of our existing workings, quite close to the mine. We also have other areas within the mine, high-grade areas, which open up for exploration. Our Rowan deposit, as you can see there, it's within 80 kilometers of our existing project. It's again high grade, 12 grams per ton, 400,000 ounces at 12 grams per ton. And more importantly, we don't need to build a mill, we don't need to build tailings facilities. We can just build an underground mine and bring that material to Madsen. So there's a pathway really in Madsen to get to 150,000 ounces a year. Between Madsen itself, the facilities we have, and the growth we see with these other deposits, we can get to 150,000 ounces quite clearly within the Madsen area. To give you a scale of that company, today Wesdome is a good analogy. Wesdome Mining in Canada, they produce 150,000 ounces a year. Their market cap is $2.3 billion Canadian. So our market cap is 300 million Canadian. So that'll show you as we do this and de-risk this project, that's sort of the value we can gain as we go forward. Again, we haven't even talked about exploration. There's loads of exploration opportunities along the Madsen mine. We have 25 kilometers of area to explore along there. One recently we discovered is we haven't really talked about our 8 zone, which is down deep in the ore body. There's 100,000 ounces in that ore body at 15 grams, sitting there in that ore body. We will get to that. It's very deep. We need to do the work. We need to develop. But what we've identified is a number of these structures. In parallel, we drilled one of those structures last year, We got some very, very impressive grades over good mining widths as well. So again, this is just upside to everything I've just talked about down the road. And again, a little bit summary, MPV, base case, bigger mine, larger complexes, other deposits to bring in, and we can see a clear path to that 150,000 ounces a year production in Madsen. Again, our management team, a young team. We brought in on our board Duncan Middlemass from Weststorm. Duncan was key in building Weststorm. Very, very experienced people. Myself, we have a young team. We put in a young team who we can build a company over the next 7 to 10 years. There's a lot of deposits, there's a lot of money, but there's very few teams. A lot of people have talked about that. We've put together a team, all have experience, all have big companies, looking for the opportunity to grow the project. We've 343 million shares outstanding, quite a few warrants. Frank is a big shareholder. Frank is a big shareholder of Sprott Resource Lending. We have Van Eck is a shareholder. So we have good institutions on our shareholders. Our volume, we have massive volume on our shares, good liquidity. We're bringing in, compared to our peers, we have lots and lots of share trading. So there's good liquidity on our stock. People can, big institutions like to see the liquidity, like to be able to come in, buy, and into the shares. And that's high level West Red Lake. If there's any questions, happy to answer it. Any other questions? Again, this is a little bit on the potential. I talked about where the reserve is at this stage by 1680, where we did the reserve. And if I change the reserve price, we did some analysis. If I change the reserve price, what that looks at. And you can see by changing it from 1680 to $2,400 a ton, basically we triple the amount of material we have and keep the grade fairly similar. So that shows lower cost, higher production, higher mining. There's our resources in place. I talked about that 8 zone here. If you look at that 8 zone, it's between 18 and 8 zone up here. You have 87,000 ounces at 18 grams material in that 8 zone, which we will access over the next 2 years. And that's West Red Lake if there's any questions.
I may have missed it, but when do you expect to be ramped up to 150,000 ounces a year?
So in the next 2 years. Sorry?
When do you run out of the mill?
So our mill, the good advantage of our mill is when we bought the mill, we're running at 800 tons a day. The mill can go to 1,500 tons a day. During the previous operators, it ran at 1,200 tons a day, no problem. So we have that 800 to 1,200, and with some capital addition, it can go to 1,500. So it gives you a good platform of growth to build upon.
Shane, has the team, you and your team, got shares in West Red Lake?
Yes, it's very important that we get all engaged in the company.
About what percentage?
So around the company, between myself and the management, about 3.5%.
And Shane, what would cause this to fail? It's failed to us.
Yep.
So at the end of the day, the doubters are saying, so if it's failed twice, why isn't it going to succeed this time? And you've made a good case for the drilling and all of that, and the spacings and understanding the stopes, and I get that part. What other risks do you see? I mean, mining is it's a great big rock under the ground. You don't know what you're going to find when you get there. What are the risks as a shareholder? What should I be aware of?
So the risks at the moment, there's a short term and a long term. So the short term risks is we're ramping up. So as you're ramping up, you're generating cash flow because you're selling gold. So you need to balance that. You have a burn rate that we're spending about $10 million a month. Let's just say to keep the mine running and to ramp it up. We're making gold every month as we're increasing our gold. Now, if the gold price went down, there's a delta there that gets bigger. So gold price is one risk over the next 12, 14 months. We need the gold price to stay up to allow us to get to that high production rate so we can balance. That is one risk of the company. And people will have their own view of where they think gold is going, but that is a risk. The other risk, I think, is as we're going underground and as we're developing and as we're getting bigger, the ability to attract people and bring areas into the people. Mining is hard to find people now. The mining industry is suffering. One of the advantages we have is in Red Lake, 50% of our people live locally in the region. So they're local, they live local, they're not fly in, fly out, we're not trying to find, they live in Red Lake.
The ASIC. So what is your ASIC, that 1600 number?
The ASIC is the 1600 in full production. In full production next year, ASIC we expect to be around at $1,600.
At 1600 in full production.
Yeah, that's Canadian, yeah, US.
Right? So 1600 is what you're predicting.
Yeah.
So, okay, and your burn rate is 10 million.
Yeah,
Okay, and what do you have in reserve right now? What do you have?
in ounces. In mine life, you're talking?
No, in capital,
Oh, capital on the balance sheet today, we have about $30 million.
30 million. So you have operating expenses and costs for 3 months, aside from what you're building and selling.
Yeah.
Yeah.
So we're selling about $8 million a month in revenue we're bringing in.
Okay, so
We're
you're
spending
selling
10.
you spend
So that
10.
2 is going, let's say there's a delta of 2 every month. So that's why I said,
You have a year.
yeah, we have a year, yeah.
Year. Right, and so as you
Yeah.
increase.
As you increase, that delta will come down.
The price of gold goes down.
Exactly. If the price of gold
Stays
went
the same.
down, if the price of gold stays the same, that's the delta we're bringing down. That's what I'm saying. As we get there, until we ramp up, then we're at steady state. But until then, we're relying on the price of gold with that smaller delta to get us where we
Do you have hedges in place?
need. No hedges. No hedges.
How many ounces do you have in the ground so far?
In the resource, we have
Yes.
1.7 million ounces of resource.
1.7 million?
Yeah.
And you expect that to grow as well?
I expect that to grow, yeah. Double at least. The mine close by to us, called Evolution Mine, the original Goldcorp mine, they're mining down at 3,000 meters now, all the way down. We're in the same body of rock, same geology. We're only down at 1,200 meters now. So we believe the ore body goes down another 1,000 meters, at least, of gold all the way down.
How much land of what you own have you explored?
We have explored very little. Our focus this year has only been on getting the Matson mine back up.
Sure. So you have a lot more land.
Not more land, not more opportunity to go.
Do you have any plans to list on the New York Stock Exchange?
We do. We're now on the TSXV. The next plan is to move to the TSX and then on to the New York Stock Exchange. So
You're on the OTC.
we're on the OTC.
Now, the percentage of the rest of how much you own, how much capital have you or the team invested on? That 3.5% just given to you as shares and warrants for being part of, or?
Yeah, about half of it has been given to share and warrants, but about half of it has been actually bought on the open
How much
market.
have you invested personally?
$158,000.
158,000. And is there anybody else on the team that's close to you?
And the CFO is close to me. She's put in.
Also about 150 or so?
We've only been at it for a year and a half.
I understand, just like to know how much of your own personal money you have invested.
At what price does gold need to stay for the next year while you're building out?
At the price that it's at now.
Okay.
So
It stays, actually, it only really needs to stay till Christmas, 1 quarter next year. Really, by then it will be ramped up, and by then we'll be steady state, and then we start to grow. So between now and first quarter next year, that's the key, the sweet spot really for us.
So at this time next year, what I take that to mean is that at this time next year, if gold drops to $2,500 an ounce, based on your ASIC, you guys can stay in business.
Yes, but once we're at that run rate, we can stay in business. It's just as we're ramping up, we're not producing enough gold to cover the costs. But with an ASIC of 1680 and gold price of 2,500, yes, we can stay in business.
I think you should get a line of capital in place in case you need it.
Well, and part of the problem has been because this asset has failed too much, getting people to come and invest in it has been hard.
Yeah.
But once we start to prove it and start to get a consistent run rate, then we can go and get refinancing and get a plan.
Sure.
That's
But somebody seeing this should say, okay, you need $1 million, you need $5 million, whatever.
they really want us to see, can we consider, the original operators ran for 12 months as well. They got up, they ran for 12 months. There's still a wait and see, So that's there. There's still
So
a
if you have to run for 12 months, then I think you're saying is, you think your burn rate will be okay if you get to this time next year, then you still need another year to run. If you can do that.
No, I don't think so. I think the market is different. Remember, the market at that time when the previous operators ran, gold was at $1,500 an ounce. With all their problems and all their issues, they were producing gold at $2,000 an ounce, as an example. Now they went broke because gold was at $1,800 and they were producing at $2,000 with all their challenges. If we've solved those challenges, and yet we're still running, even if we ran at $2,000 an ounce with all those issues, we've still a healthy margin in which to develop the project. And if gold goes higher, it's still a healthy margin.
Thank you, Shane.
Okay?
Thank you very much.